Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, September 27th, 5:28 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a mild correction, 7 to 8% off of the recent late July highs. Check the trend gauge over here. As of late last week, we are bearish on market leadership. And as far as the five major indexes go, all five are below their short-term 21-day moving average and their medium-term 50-day moving average. Mixed bag against the long-term 200-day moving average. Mid-cap, small caps firmly below there. The Dow broke down below yesterday. S&P 500 and NASDAQ 100 still above the 200-day moving average. So what happened today? Well, we came in to the morning oversold. We had a small gap up in the markets, and that was immediately sold off for like 4.5 hours, higher or lower highs, lower lows, the epitome of a trend down, and then a sharp reversal back to the upside around 2:30, a hard squeeze. We faded a bit into the close. Uh, Yields higher, dollar higher, and oils higher, all a bit of a drag on the economy and on stock market. Here are the final numbers. RG8, this is our 8 ETF composite, had a decent day today, but as of anytime you see this on a first day after a downtrend, it's just a day one bounce. But we'll take what we can get, up 0.86% on the day. S&P 500 from gap up to down to back higher to reversing, ended up at basically where it started or where it ended yesterday, up 0.02%. NASDAQ 100 was weak early in the day, showed some strength in the afternoon, up 0.23%. Dow down 0.2%. Mid caps and small caps, which have been the big laggards, had a decent day today. Mid caps up 0.56%. Russell 2000 small caps up about 1%. Global diversified 60/40 down 0.11%. Bonds the drag again as higher yields continue to be a drag on 60/40 portfolios as well as the overall market. In-house GROTECTION up 0.11% today. When we get to the tail of the tape, we'll talk about how we energized our portfolio today with a couple of buys. Here's the S&P 500, and what I'm seeing now, 150-day moving average is it's at the basis of investing legend Stan Weinstein's methodology. He uses the 30-week or the 150-day moving average as his reference point for trends. It defines his stages. Something can break back below it and then come back above it. It can go. He considers that back into a stage one uptrend as long as it's maintained. But for our purposes, what we see today is a near fill. It filled on the SPY because the SPY pays out periodic distributions, but near fill on this June 2nd gap up. That was the clear breakout from this congestion level that we experienced through April and May, and pulled back to it today, very oversold, undercut and reclaim of the 150-day moving average. So 3 reasons why we would finish positive today, and also 3 reasons why maybe we could be looking for a relief rally. The basic fill of this gap, an undercut and reclaim of a fairly significant 150-day, 30-week moving average, and being oversold and then bouncing hard late afternoon after continuing to the oversold level. Let's look at a 5-minute chart here and you'll kind of see what I'm talking about. So here's the gap up and then just relentless selling all day down to 42.38. Started to head back to the upsides and a big squeeze ignited here when we got back above 42.50. all the way up to 42.91, near the highs of the opening 30-minute range, and then a pretty hard fade, but a bounce into the close. So market trying to figure out what it wants to do here. Has it gone down far enough? We don't know. We know we've got our line in the sand, and markets never get into serious trouble unless we break below the 200-day moving average, which is now coming up to this 4,200 level, which also corresponds to uh, this high uh, way back in February, which was the first rally at the beginning of the year when people piled back into the big seven after selling them all of Q4. That was followed by a pretty rough sell-off back down to 3,800. We put in the bottom in March here. And as we tried to come up here to this 4,200 level or high 4,180-ish level, we ran into a bunch of resistance before clearing it with authority on June 1st. So a lot of support back to this level at 4,200. I was also talking about that 4,300 to 43.28 burrito layer of support. It's multiple fib levels and also some breakout levels. When we approach that 4,300 today, that's where we paused in 8 points from it in the morning open, and then 9 points from it as we rallied in the afternoon. So that 4,300 level got to be at least a bit concerned that that's flipped from support to resistance, and it's a resistance band of about 30 points or so. So about 0.75%. I would expect a little bit of a dogfight when we get up in there, unless we really see a big squeeze up to a more significant level, which would be this gap fill or the declining 21-day moving average. Those are the points on the upside that we'll be keeping an eye out for on the S&P 500. Go to the NASDAQ 100. Didn't make it down to the 150-day moving average. Remember this big rally here, first at the beginning of the year in January, then the consolidation, then the big rally and big outperformance all during May. That's why we're still as far above the 150 and the 200-day moving averages as we are on the NASDAQ 100. To be precise, we are 7.7% above the 200-day moving average and 3.1% above on the 50-day moving average. Let's go back to the S&P 500 to put a number on where we are relative to the 200-day moving average. 1.9% after getting within 1% of it early in the day and into the early afternoon as we sold off. Let's go to the Dow Jones Industrial Average. We undercut the 200-day moving average yesterday, made a lower low and rallied back into yesterday's candle, but still closed down a bit on the day. Obviously, we want to see a move back above this 200-day moving average and the 34,000 level, which was a big support resistance level going all the way back to last November. Midcaps, MDY, held at this 450 level, so that now that corresponds also to the 6-2 breakout. So another logical point for a bounce there, basically filling the gap. And IWM small caps more than filled the gap even last week, but didn't undercut yesterday's lows. We had some big strength in oils today, but mid and small caps, even growth names, outperformed today. So positive divergence there. You can see the little tick up in relative strength. Did not undercut yesterday's lows. In small caps, let me double check on mid caps. We did low 450. Yeah, we definitely did on mid caps, but not on small caps. Let's go to the VIX. VIX higher high and then back inside yesterday's candle, pretty much the same way the S&P 500 did. We're above the 200-day moving average. You'll note this 200 level was resistance every time the VIX tried to bounce up into it during the April-May sell-off. This also came after the big spike up on the regional banking crisis. So it's possible that this resistance level holds, with us being stretched to the upside on the VIX and stretched to the downside on the indices. Uh, as I mentioned, possible relief rally. We'll see what happens if it comes into the now uptrending 50-day and 21-day moving average on here. Let's go to the dollar, where we continue to get no help in the markets, making another gap up and another higher high. Massive money flowing into the dollar, no question about it, and it's definitely a headwind for stocks. You know what this does to precious metals and precious metal stocks. Here's gold making a lower low and now breaking below. So we pointed out the positive divergence, that it wasn't making lower lows while the dollar was making higher highs, finally making a lower low here, down 1.24%. GDX also making a lower low, down 3% on the day. Man, we had some hope for this sector with the setup, but not even close. And that's why we pay attention to price and not opinions. Silver did not undercut, down 1.24% on the day. Bitcoin, I've been reading some people saying some bullish stuff about Bitcoin, but for now, ran into the declining 21, really in a big, kind of tight trading range for Bitcoin over the last 5 weeks. Let's flip to bonds. Started out with a gap down, or a gap up in bond prices, gap down in yields. And this chart basically shows how bond prices just came down relentlessly all day. That corresponded, let's go to the TNX, corresponded with a big tick up in yields after the gap down, making higher highs. Back to the daily chart here, significant higher highs after really it's a negative reversal, gap down, make higher highs. It's negative from the standpoint of higher yields and the drag on the economy and the drag on the overall market. Here's TYX, the 30-year higher high, same situation, gap down, positive reversal. That corresponded to the strength in that corresponded to the markets pulling back before the market squeezed in the afternoon. TLT is the 30-year, that of course making lower lows, as you would expect with the price making higher highs. That's our inter-asset correlation. Let's get to the tail of the tape. Still oversold or negative technical analysis indicators on stochastics across the indexes, the RG8, the NASDAQ RSI, the dollar, and yields. VIX with the positive reversal ending up negative today. Fear and greed. Now, this is in green, but it's reflecting extreme fear, and that's because, remember, this fear and greed index is a contrarian indicator. We look for extremes on this, and I mentioned that system that a very smart, experienced market participant that I know very well swears that if you break back above the 30 on this, that it's a massive buy signal. And from a contrarian standpoint, that would fit the bill after breaking above 80 and then back below 80. We'll get the new numbers tomorrow on AAII. For now, we're on the bear case below the 21-day EMA. But the undercut and close positive makes this another O'Neill rally attempt day one. Still fears of the shutdown. 9 days below the 80 EMA, 9 below the 21. I started tracking this for over a year. The most I saw was 17 days below the 8 EMA. That was during the severe pullback earlier this year. Expectations, of course, remain negative with the S&P and the NASDAQ 100 below the declining 21-day moving average. From a sector standpoint, oils, coal, software, doing well. Here's the reversal on yields and bond prices from where they started today to where they finished today. On the downside, gold and silver stocks, and defensive names, staples, utilities, healthcare, and real estate. When you think about it, why would people put money into these sectors when, if you're looking for safety, you can get over 5% on a T-bill? I know that these were This is where money would flow during the QE when there was no yield to be found in bonds, but you can get it in bonds and bills now and notes. Just a thought. In-house in the portfolio. Let's take a look at this. Overnight oil ended its pullback, gapped up. All oil stocks gapped up. It's hard to find a bad looking oil chart, and this is what most of them look like, some even better. And they broke out of ranges instead of just having a bounce off of a consolidation area. But we bought NRGU back. Our last exit on this was 515. 515 was where we bought it back today. And we also bought CCJ as this had initially gapped down. Well, it didn't gap down, it gapped up and sold down hard and then had a positive reversal in a 60-minute stochastic cross. We're focused on energy because these sectors have the lowest correlation to the overall market of any of the 11 sectors, the 11 spider sectors. Energy very often zigs when the market is zagging. So we won't hesitate as much on buying energy names as we would on buying a growth leader, which they're either working or they're not working, or there are some that are holding up. But a big group move. Uranium has been extremely strong. Mike talked about the fundamentals in one of our podcasts. We've been looking at this for a while. I've missed it for a while. Finally got and it's still extended, but a decent pullback, and I could size it to where it should hold the 21-day moving average. I would lose less than 0.1% of the overall portfolio on the size that we took on a break of the 21, and I'm fine with that. So we added CCJ, we added NRGU that took our adjusted beta up to 0.68. Most of that, 0.6 of that still is our SSO position, which is the S&P 500, basically 60% in the S&P 500. So the bottom line on the day, kind of a neutral day, a little bit of everything for both the bulls and the bears. A gap up, hard fail, squeezed higher, 150-day moving average, undercut and reclaim. Leaders a decent day relative to value stocks. Yields higher, bad. Dollar higher, bad. Oils up. Overall bad for inflation, but good if you're invested in them. Certainly an opportunity to make some money. And let's go to, let's look at a couple of individual names. I said leaders acted well. 2/3 of the 21 over 21 list were positive today. Let's take a look at a couple of them. Here's coal, continues to be strong. Came back, bounced at the 21 EMA around that 100 level now. We'll take a look at the top 5. Fabrinet, nice bounce off the 21. Abercrombie and Fitch, approaching new highs off the 21. Elastic, very strong database software stock, reclaiming the 80 level. Constellation Energy undercut the 21 yesterday, reclaimed it today with some volume. And Nutanix, big shakeout yesterday as it had an investor presentation. Look at this 5-minute chart on Nutanix yesterday. Somebody dumped 800,000 shares at 12:40 p.m. yesterday. Major sell-off, and then it just shot higher. Cooler heads prevailed. It pulled back a little bit, but showed strength today, all above that level from that initial sell-off. So that 35.50 level seems to be a key level on Nutanix there. And this one certainly has our attention if the market rights itself, as that had a great reaction to its earnings report, pulled back to the 21, which is at the top of this long base, 178-day long base. Good low risk entry here, relative strength holding up also. Nutanix high on our watch list and certainly in the 20 over 21. And with that, we're going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. You can also reach out to my partner, Dan Stewart, if you're interested in becoming a client at dan@revereasset.com. Remember, it's not how much you make in the market, it's how much of that you can keep. We're very cognizant of this chart now. This is the last 13 bear markets. These all happen under the 200-day moving average. That's our line in the sand. plus or minus 1%. We avoid these with our simple enough to say is we avoid these with our discipline and our approach to the market. So give us a shout if you're interested in having your downside protected and sleeping well at night. And with that, I'm going to wrap up the video for Wednesday, September 27th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Just the facts here at Revere, just the market facts. Thanks for listening and have a great day.